Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting today the twin webinar, the monthly twin webinar, Hacking the Forex Market Together, Part 1, between 9 and 9:45 GMT, and Part 2 by 15 to 15:45 GMT during the US session. So this I have been doing it for a long time, so I wanted to give a very simple trading technique to that of the traders so that they can use it effectively and also combine the forecast with that of the trading strategy. As a result, they will be able to do the trade at ease in the market, and when they start doing the trade at ease, then the market fear goes off. So my main objective of presenting this webinar is to eliminate the market fear from the minds of the traders. So in order to understand that the forex market, we need to have the live market code page. I'll give the link for the same in the chat window for your reference, and you can use your browser to just open the live market code page, otherwise the display you can watch. Now in this live market code page you come across the currency symbol, the 4 majors and the 2 commodity pairs, then also the bid and the ask of the respective currencies with a variation of the spread between the bid and the ask. Then you come across the high set for this particular day, that is 12th December 2012, from the start of Japanese session. This is the high, 1.3014 is the high in the case of euro. Then the low set for the day, 1.2996. So that is how we will be able to find that the market is in a very narrow swing. And when compared to that of the previous day, you come across a reference level as 1 here. So the net change from that of the previous day close at the current situation is only 1 pip higher. But in the case of USD yen, it has gained about 39 pips from that of yesterday US session close. And GBP has gained about 10 pips from that of yesterday's close. So you will be able to relate the current market level with that of the high and the low, and also to that of the net change or the previous day close level. So when you relate it, now euro has become 1 pip negative net change, that means 1 pip lower than that of yesterday US session close. So when it becomes negative, it becomes red. When it becomes neutral, it is black. And when it becomes positive, you come across it is in green color. So in this live market code page, you find it might be slightly delayed about 3-4 seconds, but doesn't matter. You will be able to understand using the live market code page what is happening in the market, not only in the currency you are interested. Say for example, you are trading only in the case of euro, still you need to know what is happening in the case of the other currencies. Only then you will be able to take the appropriate decisions. Otherwise, you tend to open a lot of charts, that is chart of euro, chart of yen, chart of GBP and things like that, and try to find which currency you can take positions, etc. Instead, you come across a comprehensive information available in the live market code page, the current market level, and also the high set for the 24 hours market cycle, and the low set for this market from the day start, and also from the previous day close, how much pip it has gone up or come down. So this is the basic information. You will be able to get it from the live market code page. Now let me use the second slide and start explaining how exactly you can do the market reading. Now, you know that the market is man-made. It is not a heavenly made market. Market is man-made. So obviously men are just making the market to move up and down. So in the process, we tend to take the positions, we feel that the market is making on its own the move on the upside or on the downside based on the predominant of the traders. But if you go into the details, the unrecorded information is available, you will find that the big players in the market, they got a huge money power to make the moves in the market on the upside or on the downside. So they are the biggest component of this particular market. Then you find the normal traders, including the institutions, etc. They try to take advantage of trading and try to earn money. And in that process, we find the technicals will work, because if it is not manipulated market, then all the people try to participate in the market and take some trading decisions and apply it in the market, then invariably statistics will explain to us what could be the nature of herd mentality, how the predominant of the traders are expected to make the market on the downside or on the upside. But it will not explain with regard to that of the odds. That is the disadvantage of statistics. If one particular person is trying to trade against all other traders, irrespective of the volume, the statistics does not explain it that way. It is also taken as one of the sample. And they have another statistical method, namely the weighted moving average. But again, in the weighted moving average, we need to find out how much of weightage can be given for that of the moves made by that of the players, and how much of weightage we have to give it to that of the individual traders. And if you are able to decide on that, then our statistics will work. Until such time, you will find the statistics will appear working, and suddenly the market deviates, and you can simply give an excuse, and that market has surprisingly made a move against that of the expectations. So ultimately we need to find out how the players have identified the market, forex market, in order to make the moves. So naturally you come across it is a 24 hours market based on the global cycle. So the market has to start from that of Japanese session as the sun rises from Japanese area. Then subsequently you come across it has to last till late US session. So then you come across the universal time, namely the GMT time. This GMT time, you come across the international date line, which is closer to that of Honolulu. Then from there the next day starts. That is how the calendars are being prepared when you go in for a 24-hour cycle, not based on the sunrise and sunset. When you go in for the 24 hours market cycle, you will find that date changes once the globe crosses the international date line, which is exactly opposite to that of the GMT line or the Greenwich Meridian line, which is closer to that of London, passing through Greenwich. So you have to understand that this is a naturally occurring phenomenon. And also you find that the banks which are in one particular area, like Asian and Japanese and other area, when they close their normal trading hours, and they don't do the trades for the importers and the exporters, the currency conversions, then afterwards there is a gap between that before the European session starts, or the European banks participate in giving the currency conversions. That is local time, like 9 a.m. or 9:30 a.m. and things like that. So this gap is being used by the other big players in order to make some quick moves in the market to try to trap the traders. Then after that there is a naturally occurring 30 minutes gap between that of the European and the US session. You can simply call it as session 1, 2 or 3, or just give a name like Japanese session, European session and US session. But these are all the natural timings followed by the other players. If you want to track the players, then we need to use the GMT time here. Now current GMT time is 9:12:42 GMT. So this GMT time, we know that European session starts by 8 GMT, and actually 1 hour and 12 minutes have passed after the start of the European session. So how exactly they are going to make the moves during that of the European session, and that could last till 14 GMT. And so this way you need to understand the session timings and naturally available gap time in order to find out what sort of moves they intend to make in the market. And they make the moves in sequence. So after one move, you will be able to predict easily what is going to be their next move. I'll explain to you how you can read it today, so that when you see that particular move happening, then you can find the opposite move is expected to happen, accordingly take your trading decision. So in order to understand the players, we need to first of all track them using the live market quote page and the GMT time in order to distinguish the sessions. Then of each session, what I have marked it here, the first 1.5 hours will be called as the early session. That is how they use it. That is why I am calling, I give a different name, early session, but they might be having a different name. Doesn't matter. But first 1.5 hours, they is called the early session, and the last 1.5 hours is called the late session. So from 6 to 7:30 GMT, here is the late session, and 0030 to 2 GMT is the early session. Similarly here, 8 to 9:30 GMT is the early session, and 12:30 to 14 GMT is the late session. So they have the early session, then in between the early and the late session is the mid session. So from 9 GMT up to 9:30 GMT up to 12:30 GMT is the mid session. So why they are segregated like this? Because they handle during that of the early and the late sessions the majors, and try to make an upward stop and or a downward stop in the majors, and the mid sessions they do the upward and the downward stop ins in the case of the crosses. So if you are trading in majors, you focus in the market during the early and the late sessions, you will be able to quickly enter and exit out of the market. If you want to trade in the case of the crosses, then try to make an entry and the exit during the mid sessions. Then you will find that waiting time is very less in closing the trades with a profit. Otherwise, if you simply take the position at random according to your local time, as soon as you get up around 7:38 in the morning, you just open the trading platform and just take a position, then you expect the universal market to come to your time frame. Then you subject yourself, or you expect the market to be subjective to you, but it is an objective market. So you know that statistics, one of the main hypotheses in statistics is it has to be objective, not subjective. So you need to find out that the market is 24 hours, so we have to follow the market in GMT time frame and understand the subcomponents of the time frames they are using it. Then you will be able to easily track the players and their moves. And once you identify one type of move, then following with the other type of moves will be much easier. Then that helps you in a great way the trading decisions. Ultimately, the entry decision and the exit decisions are to be very, very important for us to make money. But most of the traders decide upon the entry, but they fail to decide on the exit. And sometimes they just find that entry is good and take a position. Subsequently, they are stopped out. They are afraid of taking another position. Then the market moves as per the expectations, but they don't have the positions. So these are all the situations you come across while doing trading. And some may say that the trading is, I am not lucky enough to make money from the other market, etc. See, ultimately it leads to that of lack of understanding of the market. When it is a man-made market, then you need to know how the man is trying to behave. Suppose you come across a policeman standing near that of the signal, and he is manually operating the signal due to some reason. Then when you see the cycle happen in a different way than that of the automatic signal, then next time when it comes, you are able to understand which line direction or which way the police is going to allow the traffic. Then you prepare yourself and try to make your journey easy. So ultimately you need to understand what the policeman is going to show, which way he is going to allow the traffic. So in the same way, we need to read other man's mind, especially the player's mind, in order to be successful in trading. So if you ask any successful businessman in the world who have come up very nicely and build the empire of business, they will simply say that they have understood the mind of the consumer, or they understood the minds of their principals. So ultimately, the understanding of the other man is more important in order to be successful. Why? Because we know what sort of decisions we are going to take, but how the other man is going to take the decision, if you ignore and try to take your decisions, then other man's decisions might be exactly opposite to your decision. Then you may not be able to make money. So ultimately you have to synchronize your decisions with that of the other man's decision. Then you will be able to get along with him very nicely and try to take the advantage of that particular association. So this is how you have to logically understand, because as long as they are human, they have their limitations. They are not gods or to make miracles in the world, and they can only do like any other human. But only thing is, because of the money power, they appear very smart, but actually they have the money power, but they don't have the smartness. And if you talk to any of the richest in the world, and you can simply find out that he has got a lot of ignorance, and by fortune you would have earned the wealth. And that is why you come across in the yesteryears, many of the billionaires of the yesteryears, if you see, and they have not been ruling the world all the time, and by luck or by fortune they would have earned such money, and subsequently the money also goes away from them as they were earned. And if you see some of the successes of those people, they will not be completely ruling the world. And probably you might be wondering to see some of them might be beggars. And that is how the world cycle is. So we need to understand that they are having the money power, but they are not smart. So keep that in mind. What you have to do is, because the money power they have, I don't have the money power. I am trying to trade with $5,000, $10,000, whereas they have got billions and billions of dollars. So it is extremely difficult to trade against them. So I just follow them. Okay, when they are buying, I'll also buy. When they are booking profit, I'll also book profit. There's no harm in it. So trying to find the weakness or limitations of the players and trade along with them. And it might appear we are doing a contrarian trade in the market, but that is how they present the market to us and suddenly bring in the changes so that the traders get trapped. Because nobody enters into the market with the objective of losing money. Everybody wanted to make money. But in the process, when they become surprised when the market moved against them, immediately they find there is no other go than to limit the risk, because their equity is limited. Then they go in for a distress trade. So ultimately what the players do it, they make the market appear moving as per the expectations of the technicals and fundamentals, and try to introduce the opposite. And you will be thinking that fundamentally the market, euro has to go up, or euro has to come down. That is how you will be thinking because of the economic conditions, etc. Then you think that, okay, I can do a sell and buy trade. Then afterwards, suddenly euro might go up. Then you will come across the news that the US data was weak, because of that euro has gone up. Okay, fine. When the US data is good, so obviously euro has to drop. Like on Friday, the non-farm payroll was very good, and you know that euro and GBP started making a small dip of 10 to 15 pips and 20 pips and were holding for some time. Then during the US session, they firmed up. And later on Monday, they have been holding around that of the low or closer to that of Friday close level. And from yesterday onwards, they started gaining the levels. Now, what happened to non-farm payroll? Whether the impact of non-farm payroll is being discounted, or probably you have to discount and look for FOMC outcome today. So we are asked to just follow up the events which are going to be announced just once in an hour or once in 2 hours and things like that. So once you are asked to wait for an announcement, breaking news, etc., then you lose the patience. And by the time the announcement time comes, say for example there is going to be an announcement around 9:30 GMT, you become tensed from 9:25 GMT for the 5 minutes time frame. You will be simply watching, and euro has just breached the high and gone up. Why, when everybody is waiting for the data to come, why euro has gone up? You will be wondering, and you will be looking in various websites, calling your friends and finding out, or participating in the chat, why suddenly euro has gone up. Any news out, any breakout of the news and things like that, or leaking of the news. You start questioning so many things. So what happens? You become totally diverted. Rather than focusing on the market, somebody has just made a higher level buy. As a result, the market has gone up. You fail to understand. Instead, you look for various excuses. So this is why you find the traders find the market is continuously a surprise event. So these are all the time frames. This webinar is being recorded. You can also note down, and later on if you have any difficulty in understanding the timings, you can ask me questions. Then I showed you the live market quote page, how to use the live market quote page. So this is the most important thing in order to understand. So track the market using the live market quote page. In that, note down high, low and net change in 4 majors and 2 commodity pairs, which is available in the link, and 4 majors and 2 commodity pairs, the high, low and net change around 3:30 GMT. And they are referred as the initial low and initial high. I told you that the players are not very smart, because they have a system of this nature. Set the initial low and the high around 3:30 and start making the downward stop and upward stop and things like that. And they are not using any sophisticated calculations. It might appear that it is a grand old understanding, but you might think that how simple it is just to note down the initial low and the high and try to make the moves. Being the player, they don't do any statistical analysis and things like that. Yeah, that is how it is. Because they only ask others to follow such analysis, but they don't follow the analysis. So you need to understand, when others follow the statistical analysis or the technical and the fundamental analysis, and these people decisively make opposite move to that, so that they are able to hit the stops. It is simple technique of making money, because they have got the huge money power. Okay. I explained the net change indicates the current market level from that of the previous day or the US session close. I explained it. Watch when the market is near low or near high, and when it is in the middle level, simply relax yourself. That means they are only going to make swings, and only if they are near that of the high, near that of the low, you watch it. Thereby you will be able to take the appropriate decisions. For that, what you have to do next is note down the type of moves they do it. So with the help of the initial low and the high, I will try to show you what sort of moves they intend to make today. Now, as I explained that the early and the late sessions with regard to the market timings, they handle the majors, and during the mid sessions they handle the crosses. Now, the type of market moves, what they are doing it. So before that, let me show the other slide. Here you come across the initial lows and the highs. This is the slide I use while giving the Asian Session Live Market Analysis webinar, and this particular slide I note down the initial lows and the highs and display it to that of the people who come for this particular webinar on Monday and Thursday, and I also ask them to note down that and try to read how the players are making use of it. So today 3:30 GMT, it was 1.3001 was the initial low and 1.3014 was the high. If you see in the live market quote page, they came down to 1.2996 during the late Japanese session and made a small dip to 1.2996. 1.3001 was the initial low. From there they dropped about 5 pips. And then again gone above that of 1.001 in less than 30 minutes and started gaining the levels during the European session. The initial high was 1.3014. Now they have gone to 1.3021. And if they sustain above that of 1.3014 for 30 minutes, you would have just seen that around 9:15 they just breached around 9 GMT itself they breached the initial high 1.3014, and they are holding above that for more than 30 minutes. Then you find the lower move was in less than 30 minutes, the higher move was more than 30 minutes. Hope you are able to understand that. Now in the case of GBP, 1.6112 was the initial low. They made a downward stop and up to 1.6095, and the high was 1.6121 during around 3:30 GMT. They went up to 1.6133. So they made the downward stop and an upward stop, and because today 19 GMT FOMC announcement is there, so they are trying to make the swings in the market, not in a big way, but trying to make the upward and the downward stop and try to earn and also induce the traders to take positions and cut it out of fear. When the position becomes negative, immediately the traders perceive, oh God, FOMC is going to be announced and already it is making about 5 pips loss, so let me better cut the position. So that is how they close, and later on he waits for the FOMC announcement, and after that the market moves as per his expectations on the upside. But he can only repent because he failed to take the positions. So the market fear invariably make the traders to take wrong decisions. So you have to get rid of the fear. Suppose you want to be a successful driver in driving a car, you have to get rid of the road fear. Only if you get rid of the road fear, you will be able to develop the navigational skill, and you will be able to develop the road sense. Once you develop the road sense and understand the mechanics of how to drive the car, then automatically you find that you move the car as if you are just running. So you synchronize your body with that of the car, so you are able to perceive from the front to that of the back. Even though you are a small tiny person sitting in the car, you are able to perceive the length of the car and try to maneuver in the road after developing the road sense without causing any accident. So it is a question of how you get rid of the fear. So the market fear has to be eliminated, and then you have to develop a sense of trading and perceive the market and read the intentions of the players, because visibly they are not available, the players are not available. But whatever the hidden agenda of the player, they have to disclose it in the market by making a false move. If they want to rise the market, they will make initially a brief downward stop in less than 30 minutes. If they want to drop the market, they will briefly make an upward stop for 30 minutes, less than 30 minutes, and then start making the drop. Is it difficult to find out? Not at all. When they make an upward stop and try to and see that it comes below that of the initial low in less than 30 minutes, take a sell. You will have a definite profit on the downside, at least able to close around that low. And if you trail the stop, you will be able to maximize the profit in case if they drop further down. Similarly, on the upside. And many of the traders think that, okay, when euro has gone to 1.30, no, it is untouchable. We cannot take buy. It is the highest level. So immediately they develop the reservation because they have seen euro trading around 1.29, 1.2950 and thinks that 1.30 is an expensive level. But the players shift the trading zone on the intraday, on the upside and the downside, so that the traders are always kept on tender hooks. They will never be in a position to relax themselves. And probably such traders may not even talk to his wife properly. And he will be just taking very less food and probably keep awake for more than the normal expected hours of working. And you find odd hours, you keep awake and try to see the market is giving some trading opportunity, etc. There is no need at all, because the market is 24 hours market. Anytime convenient to you, still they continue to give the trading opportunity. During that time you can participate in the market and try to earn money. See, if not buy and sell trade, you can do a sell and buy trade. So ultimately what is more important is whether you are able to make consistently money. Now, in the case of yen, 82.48 was the low and 82.62 is the high, whereas they have gone much higher to 82.93. And if you see in all the three currencies, Euro, GBP and USD yen, the net change is positive. So you will be able to understand that it is a contrarian move to rise the yen crosses. If you see the yen crosses, you find Euro yen has gone to the high for the season. GBP yen has gone to the high for the season. So how it is possible when they are making a contrarian move of this nature? Because they know very well predominant of the traders won't commit positions in majors. They will be waiting for the FOMC outcome. Similarly, many of the traders would not have committed before the announcement of the non-farm payroll. So they will be waiting. But those who wait for the outcome of the fundamental news and then later on they find that, okay, when euro has started dropping, they think, okay, US data is good, there is no point in doing buy and sell trade, so it is better to do a sell. So we will try to sell near that of the high, but they are not showing the high, it has already made the top. And then they either decide to sell after the drop and later on find they are stopped out. So though they just derived a lot of information from there, but the market is not waiting for them, and subsequently when it has gone and hit their stop, he thinks that, okay, it's not the right trade, probably wait for FOMC outcome, then later on commit a position. So FOMC is to be announced by 19 GMT. Till such time we will not participate in the market. So invariably you will be spending a lot of time on waiting because the uncertainty continue to grip his mind. So we need to understand what the players are doing. When they are doing a contrarian move, when euro and GBP are going upward, it is a USD weakening move. When USD yen is going upward, it is a USD gaining move. How can the currencies move like that? Then you will come across an explanations that because of Japanese economic condition, yen has weakened. And because of the strong fundamentals from that of Europe, euro has gone up. What happened to GBP? Okay, It's a market sentiment, so euro has gone up, so GBP has also gone up. Okay, why Australian dollar has gone much more than that of euro and GBP? Okay, Australian dollar is considered relatively the strongest currency. So you continue to get excuses. And yesterday you would have noticed Australian dollar was just finding it difficult to cross about 1.05. Many of the people said that, okay, I am going to short because it is going to drop from there, because it's finding it extremely difficult to breach 1.05. It is not sustaining there. But now you find 1.0523 is the low and 1.0549 is the high. So what you derive yesterday, it becomes meaningless today. And before FOMC, what you derive becomes meaningless after FOMC. So that is why we are in pursuit of what is going to be the next event, how the market is going to behave. Still, we find it extremely difficult to understand the market. But it is a man-made market, so ultimately we need to know what the other man is going to do. So they use the simple technique of initial lows and the highs. I told you GBP, USD yen, they have gone up. In the case of USD CHF, you find that 93.12, they just breached it by 1 pip, and 93.27 is in such a narrow range because not many traders are taking positions. Here in the case of Canadian dollar, 98.56 was the low, and they just breached it by 2 pips, and 98.66 is intact. So they are hardly making any move, no trading opportunity. Then in the case of Australian dollar, 1.0523 and 1.0542, they breached the high and staying above that of 1.0542 and 1.0546 is the level. So let me give you the trick. When the net change is more in the case of Australian dollar, then this is the first currency they are going to move upward, followed by that of euro, then later on GBP. This is how they will make the moves in sequence. So when they rise Australian dollar first, what happens? Euro is holding, Australian dollar is rising, so the denominator currency in euro USD, the denominator becomes stronger. Euro C is here. Then the numerator currency is weak. Then you find that particular currency pair, start making the slide. Euros. Okay, fine. You start making the slide because Australian dollar is relatively strong when compared to euro, because it has made more pip on the positive side. You find it start making the slide. So what is responsible for this move on the downside in the case of euro Australian dollar? It is not that euro Australian dollar somebody is making the currency conversions, etc. It is because of the move what they are doing it. So the moves, they do it in major, and that gets reflected in the case of the crosses. That you need to understand. So it is like a puppet show. They have the strings and they just pull the strings in a different fashion, so automatically the puppets also dance, the crosses also dance. So let me minimize the initial lows and the highs as I explained it, that they just breach the initial low and the high in euro and GBP. They breached the high in the case of USDN and briefly in the case of USD CHF on the downside. Canadian dollar also only by 2 pips on the downside. Australian dollar on the upside. Then what happens? If they make a move in less than 30 minutes, it is a stop and or a false move. Stop and the condition is they go below that of the initial low and come above that in less than 30 minutes. False move is the one they go up to that of the low and reverse it, or go up to that of the high and reverse it. That is false move, which also happens in less than 30 minutes. So they pretend as if the market is going to go up at the time of release of the non-farm payroll and start making the drop. So that is a false move. So the false move, they do it during that of the gap time and also before that of the data release time. So if 19 GMT FOMC is going to announce, we need not worry about what is going to be the outcome. And from 1845 to 19 GMT, if you watch, if they make a quick downward move, then understand after FOMC they are going to rise it. So you can understand that they always make a false move before making their intentional move. Because in the money market, if you want the money to multiply without converting into effort, the only way possible is cunningness. So by using the cunningness, they try to dip and pretend as if it is going to drop and rise. And they try to rise and pretend as if indefinitely it is going to rise and then make a big drop. So that is what they can do it. And now you come across a situation in the case of Euro and GBP, an extended move. Go above that of the high. Today is a condition of go above that of the high and cut the new high and stay above there for more than 30 minutes. 1.3014 was the initial high. They have just gone above and they are staying here for more than 1 hour, 1.5 hours now. Then what happens if they continue to cut the new high? Then it is an intentional move on the upside. But if they stop cutting the high in 30 minutes but only hold here, that means they are building sell positions. They are holding above that of the initial high but not breached the new high. Why they are not breaching the new high? They create the bullish field, induce the traders to go in for a breakout trade, buy. They don't give profit by making a rise. Simple. If they don't rise, then those who have taken the buy positions cannot make profit. So the traders who have just taken the position, they cannot push the market upward or the downward. And the players have to move it. And they know that predominant of the traders have gone in for a breakout trade, taken a higher level buy. They don't push it upward. They only pretend as if Euro is going to rise, but they are simply holding it. After 2 hours, if they don't breach the new high, that means they are going to drop. In case if they cut the new high and continue to rise, what happens? Anybody who has taken the buy position here was given a chance to keep stop at entry or at least close it with a nominal profit. So if they drop, those higher level long holders are not going to come for liquidation because already they have booked a profit. There is no position to liquidate or go in for a distress trade. So you have to understand there are two types of traders. They do either buy and sell or a sell and buy. But the players do lower level buy and higher level sell, or higher level sell and lower level buy. But we traders sell after the drop, buy after the rise, in the name of bullish and bearish. So you can understand we fail to use our common sense, and that becomes an advantage for the players. Then they cut the high and continue to cut the high for more than 2 hours. And if it is a slow rise, then it is an intentional move. The intentional move lasts for about 2 sessions. Like yesterday, they continue to rise during that of the European and US session. I made a remark in fxstreet.net blog that they are making an intentional move on the upside. That means avoid doing sell and buy trade. If you sell, you will get struck. Then they continue to rise, and the next day they open higher and continue to hold and form the low, which is higher than that of yesterday's high. Today's low becomes higher than that of yesterday's high. That is how they make it. Then automatically the traders come for buying, short sellers come for buying. So they know how to trap the traders. So in the intentional move, they just continue to rise or drop the market for 2 sessions and pretend to continue the rise on the 3rd session or drop on the 3rd session and reverse. So if you could understand, if they continue to drop, continue to cut the new low every 30 minutes and things like that, okay, you know that Japanese session they started, European session I will not take any position. Let them come to US session start, make one dip quickly, I'll take a buy, they will start making a rise. 100% you will be able to book profit. So if you understand them well, if you understand their limitations, then you will be able to consistently earn from the market. Then We have done so much of study, still our study may have some failures, no limitations. As long as you are human, we are bound to make mistakes. So, in order to limit, we need to have the trading strategy, limit the risk, because our hard-earned money, we should not just like that lose it in the market because of the gambling tendency. So, we have to use the hedging order to limit the risk if you have the hedging facility in the trading platform. During part 2, I'll explain to you, in the absence of hedging, how exactly you can handle the positions. So European platforms, they offer hedging. So in case you just take a buy position, you keep 30 pips below a hedging order, and so not hedging at the market. Many people think that hedging means you hedge it at the market. As soon as you take a buy, 1.29 or 1.300 buy, 1.300 sell, it doesn't make any sense. No, we have to keep the hedging order to limit the risk around 1.2970. In the event if the market comes down, you will be hedged so that you don't face an unlimited loss. It will be a limited loss. Then they start making the rise, and you will be able to understand it was filled during stop end. So there comes the understanding of the type of moves. The type of moves I explained: stop end, false move, extended move, intentional move, and during mid sessions they make swings, and during gap time they make false moves. So you have to identify when they are going to do such type of moves. Stop ends, they do it during the session start and the session close time in order to handle the majors. So if you watch the market, they are closer to that of the high and not breach the high, you can take a sell near that of the high and you will be able to see the drop. You can take profit. Entry can be decided like that. In the event, if they have just made an extended move like today, then gone above that of the high and staying above that of the high and below that of the new high for 1 hour, 1.5 hours, then probably you have to wait for 2 hours to get completed. And after 2 hours you will find that they will start making the cutting of the new high. Then you know that it is intentional move. You can take a buy even though it is closer to that of the high set for the day. Still you can make a buy because their intention is to rise further up. You will be able to definitely book profit. So there is no question of fear associated. Oh God, I am buying at a higher level. Because in order to eliminate the fear, we keep 30 pips below that the hedging order. Whether you buy it at 1.3026, you keep 30 pips hedging order. Whether you buy it at 1.2996, you keep 30 pips hedging order. Whether you buy it at 1.2121 long back, still you keep 30 pips hedging order. So ultimately, whatever, irrespective of the levels, we will be taking a calculated risk only for 30 pips. The levels are immaterial if you use the appropriate trading strategy. So the level gives the illusions to us, but ultimately the trading strategy remains the same and the type of market moves remains the same. That is why the players make an upward move and show a new level, create the bullish field, show a lower level and create the bearish field. So easily we become victim for such changes and we try to become sentimentally bearish or bullish, and alternate moves they make it in order to trap it. This is the game plan. So entry you decide based on various factors I told you, and today for example they just breached the initial high and stayed above there for more than 30 minutes, still above that of 1.3014. So if 2 hours completed, we can take a buy there. Definitely they will make a rise and you will be able to book profit. Similarly in the case of GBP. So it's a condition of that. Sometimes they go below that and stay below their initial low for more than 30 minutes to 2 hours. Then they continue to drop. You can definitely take a sell position at that time. Keep the hedging order 30 pips above. So always we take only risk for 30 pips, whether it is a buy and sell or a sell and buy. And when they start dropping it, we keep stop at entry to eliminate the risk. And when they start making further drop, we book profit. Then exit. Always quick moves or false moves in the market, as I have been telling many times. Now euro, they just dropped it. So watch it. So it doesn't give really a trading opportunity. So if you wait carefully, you are able to really understand that they are making only small swings in order to handle the respective crosses. Because not many traders are taking positions before FOMC. It shows very evidentially. Then take profit. Once the position makes profit of 15 to 20 pips, you keep stop at entry to limit the risk, and you will not have any risk, and you will be removing the hedging order. So the hedging, you will be using it instead of stop. Once the position start making profit, you will keep stop at entry, and then if the market comes down, you will lose the position, but no money is lost. If they go up, you will book profit. Then once the position makes about 25 pips profit and more, you trail the stop and keep the limit somewhere around 45 pips or 75 pips, a theoretically calculated level, or you find that it could go up to the resistance, you keep there. When they move without hitting your trailing stop, then move the limit away from the market and maximize the profit, because your trailing stop anyhow will protect the minimum profit for you. So there is no greediness involved in that. You are trying to take advantage of the market move. So that is how the entry and the exit decisions are being taken. In the case, if it is hedged, then you try to watch whether the hedging is making profit or loss. If the hedging is making loss for 30 minutes of your observation, once it is hedged, understand that it was filled during the stop and simply close the hedging with 2-3 pips loss, or with a stop at entry or 10 pips loss. Then when they start, keep another hedging order to limit the risk and start trailing it upward when they rise the market above. And once the original position buy makes profit, keep stop at entry and try to book profit. So you lose only 2-3 pips here using the hedging. Still the original buy is there. When they go above, you are able to make profit in that. So ultimately you will be having net profit. So if you use the hedging, you can use it instead of stop and remove it afterwards after keeping stop at entry. Otherwise, you can just read the pulse of the market by using the hedging, and if the market is going against you, the hedging is making profit, then you understand that your calculation was wrong, the market has gone down deeply. Still, you don't make unlimited loss. You have in such platform a provision that you can close the original position with the hedging. Still, even after 2-3 hours, if you close the position, you will incur only 30 pips loss. So that gives the greatest advantage for you. And relook at the market again and try to enter into the market. See how simple it is when you use the hedging. There is no distressness, and there is no question of feeling bad that your position is locked and things like that. This is how to handle the hedge. Wait for 30 minutes. If it is hedged and if the hedging is making loss, close it and keep another hedging order. If the hedging is making profit, keep stop at entry. Let them drop anywhere they want, and later on when they reverse, your hedging will be closed with stop at entry and make upward move. You will continue with your trading. So if the hedging facility is available, try to make use of it. Now, with regard to the trading decision, as I explained, after 2 hours holding around, they come below that of the initial high, 1.3014 in the case of euro. So they are making only a small swing, upward stop and an extended move on the upward, and they are trying to make a false move coming down before making one quick rise because of low volume condition. Then also in the case of GBP, they are still holding above that of the initial high, and in the case of Australian dollar, still they are around that initial high, and it is making the higher profit. So when the market is very subdued, there is no point in taking a position and simply wait for the market to make 1 pip, 2 pip profit, and you become you lose your patience and become impatient and things like that. Because it is mid-session, they are handling it with subdued moves in the market. So I intend to say that here I am not taking any position now in the market. This is the first time that I am not taking the positions in the market because they are making very subdued moves. Lack of volume is there, and that could be the reason. So because they made that extended move and come below that, and if they stay below that initial high for more than 30 minutes, then they will continue to make a dip up to that of the low and then only reverse. So the ideal way will be wait for the late European session, then we try to take a buy position near that of the low or the psychological level 1.3000, and then try to maximize the profit on that. So they had done only the initial downward stoppment, and they just made an upward extended move, again come below. They are making only small swing. If you would have taken a buy here, you would have earned about 20-25 pips, because when it comes to 1.3026, then we will not be able to exit exactly the same level. Around that we will be able to do that. So they are only giving about 15 to 20 pips. Even the scalpers will find it is not a very good market to do small scalping for 5-10 pips. Okay, I'll just go through the questions which asked here. Okay, then Hardy has got a question. Use high-low of day, week and month to predict the market. I use it for my market reading, but market prediction is based on a statistical algorithm. Where can I download the recorded webinar? See, once the webinar is completed, you will come across the link will be given here. It is very simple. You go to fxtrade.com and click webinars, and below that sublinks will be there, archives. You click the schedule of the webinars. The webinars which are going to be followed will be listed in the schedule archives. If you click, you will find all the recorded webinars are available there. And for your convenience, the host will give you the link here in the chat. You can follow it and go to the archives, and later on, whenever the webinars are recorded and they will upload, and you can just go through those webinars. In case because of the time difference you are not able to attend that, you can always listen in the recorded webinar. See, FX Street is doing a great job. See, now you got it. A great job of recording the webinars and displaying it for free of cost. So you have to take advantage of it. Okay. How do they make the market trending? Market trending is depending upon the traders, predominant of the traders, how they are taking the positions. So it is a year-end time now, December. So they intend to make an upward move in the case of Euro and GBP, and that is why they have been predominantly giving the feel that European economy is weak and US economy is becoming stronger and things like that, and they can easily derive such informations from that of the data release, etc. And you find that slowly they are gaining the levels in the case of Euro and GBP, and by year end they have to hit the options in the futures market, but that they have to make very quick moves. Then they are expected to make an upward move, because December they started with a downward move. Everybody was telling that Euro could go to 1.27, so they would have just made the put option around 1.27. And if you see the expert advice in the case of FX Street, which is being displayed on Saturday, you can see predominant of the experts are bearish in the case of Euro and GBP. So traders also tend to take sell positions, then afterwards or put options. Then later on they gain the levels about 200-300 pips by year end and induce them the options to expire with the loss, or induce the short sellers to do the short covering. That's the game plan. So by making Euro bullish or bearish, the players are not making money. Only when the traders lose, the players make money. Okay, fine. Thank you. I am finishing it. So No more questions, so let me go to the last slide. So I'll present part 2 of the Tracking the Forex Market webinar by 15 GMT. At that time I'll try to take the position, because your session they are expected to make very quick moves, and I will explain to you, or probably I might be able to book profit during that particular time frame. And I'm sorry that I have not taken any position during European session, because the market is really subdued for want of volume. So I'll again review the initial lows and the highs set here by 15 GMT, and tell you what exactly they are done with regard to the initial lows and the highs and the new highs and the lows. Then you will find the market reading technique is really simple. So I take this opportunity to thank FX Street and you people who have come here to attend the webinar, and please do come for the part 2 of the webinar. I'll give you more information pertaining to that of the market reading, and you will be able to really find that you get rid of the market fear. Thank you one and all. See you by 15 GMT.